Hi, good morning. Assalamu alaikum. Thank you all for joining in today. My name is Rahim and I'm excited to be your host. DD Consulting deals in with actuarial services, actuarial valuation, sustainability, Insurtech, IFRS, ORSA, IAS 19, risk management, business and financial planning, and many other actuarial services. Today, we will be covering some fascinating and important topics: unfolding CBUE newly introduced recovery planning regulation by Mr. Hussain, understanding risk management framework by Mr. Hassan, Insurtech product structuring by Mr. Logan, and UE market insurance report by Mr. Kurat. We encourage you to ask questions, share your thoughts throughout the session using the question and answer function. We will address as many as we can in the end of the session. You can keep on writing in the chat box and we will answer them in the end. If we miss out any of your question and answers, we will send it to you. I would like to welcome our special guest, Mr. Kurat Khan, who is an assistant manager in DD Consulting, who will share an insight on the UE insurance market and updates on it.
Thank you. Thank you, Ray. I'm just sharing my screen. Yeah. Thanks, Ray. Assalamu alaikum and hello, everyone. I hope you all will be fine. I will be presenting an analysis of the reinsurance industry performance during the first quarter of 2024, comparing it with the same period of 2023. This webinar will focus not just on industry trend, but also on the new regulation of the CBU for 2024, like risk recovery plan, risk management law. Before we begin, I want to mention something important. Don't miss the end of this session because I have some exciting news about the second quarter. So please stay with me till the end of this industry analysis. Now let's start with an overview of the reinsurance industry for the first quarter of 2024. There are 26 listed insurance companies, and the competition in the UAE insurance market is very strong. In the industry highlights, we will first cover the overall progress of the insurance industry as of 2024 Q1 compared to the same quarter last year, 2023 Q1. We will look at insurance revenue, insurance service result, and profit before tax. Then we will drill down into the top and bottom insurance company that achieved the highest profit and insurance service results. In 2024, insurance revenue saw significant growth, increased by 24% from 2023. Similarly, insurance service results grew by 7%, reaching 315 million in 2024, up from 296 million in 2023. Additionally, the overall profit of the 26 listed insurance company increased significantly by 29%, with profit rising from 559 million in 2023 to 722 million in 2024. Now let's move on to a detailed breakdown of these three components on the company level. In terms of the insurance revenue, Orient, Sukoon, and Adnic are the top contributors, making up 41% of the total industry revenue. These three companies generated 3.46 billion out of the total 8.5 billion. The remaining 59 came from the other insurance company. DIN performed exceptionally well, achieving growth of 79%. On the other hand, Align experienced the most significant decline, with a 32% drop in the insurance revenue compared to the last year. Now move on to the insurance service results. Insurance service results include the insurance service expenses, the allocation of reinsurance premium, and the claims. Here we look at the same company as we did in the insurance revenue. The insurance service result for the top three companies by insurance revenue includes 14 million from the last year. Other insurers also saw a rise in their insurance service result with an increase for only 5 million from last year. Out of all insurers, 9 insurance companies had negative growth, while 17 showed positive growth. NGI showed highest growth with an increase of 21 million in insurance services, while Avnik faced the most significant decrease, dropping by 7 million. Now let's move on to the profit before tax. The overall profit of the 26 listed insurance increased significantly by 29% from last year. Orient, Sequoia, and Ethnic are the top insurers in terms of the insurance revenue. Out of the 26 company, 21 made profit in 2024, while 5 made losses. The top three companies contributed 74% of the total profit and a consistent growth of 34% compared to the last year. The remaining companies accounted for 26% of the total profit before tax, showing a growth of nearly 18%. So that was the high level industry highlight. For further details, you can download the report from our DD LinkedIn page. So in the end, I want to share the news. It is about 2024 quarter two. In quarter two, the insurance industry is expected to face challenges due to the recent floods in the UAE. This is likely to lead to significant losses for company, reversing the expected profitability trend. So I will hand it over to Rahim to continue. Thanks. Now you can carry on.
Wow, thank you so much for sharing an informative insight on UE market. This will clear many doubts. Wow, quarter two report, we will all wait for it. Thank you so much, Kural. Now I would like to welcome our CEO and founder of DD Consulting, Mr. Hussein Feroz, to share his views on the most important topic, which is also under the deadline of 30th June, recovery planning.
Thank you, everyone. Thank you for joining our webinar. And I'll just start with a short introduction about myself, and then we jump into this recovery planning discussion. So, my name is Hussein Froz Ali. I'm a qualified actuary, and I have lived and worked in Dubai for about 12 years. And for the last 5 years, I have been running this actuarial consulting firm, which is called DD Consulting. Within the Dubai and the Middle East market, we operate with the brand of DD Consulting, and we have clients about on IFRS 17, actuarial valuation, IS 19, etc. And outside the Middle East, we also have a group entity in Malaysia, from which we cover the Southeast Asia region, like Malaysia, Cambodia, Indonesia, etc. And the founder of the Base Consulting is Logan, who you will also speak in the next session. And from his entity, we specialize on Insurtech consulting. So let me dive in straight to the topic of recovery planning. Okay, so a lot of time, I think the way human nature is, we always talk about growth and positive and going forward, right? So a lot of emphasis within our life, like if we evaluate, so whether it's our career or anything, so we are always talking about going forward and progressing in life. And there are always risks in whatever actions we do, and we are always kind of like ignoring the risk. But sometimes some worst events happen, and that got us into panic because we never planned for those risks. Like if you think about the strategy meetings that you do in your office, all of that focuses on the aspect of growth and how we can achieve big numbers. So I think this is the first time I've seen that a very comprehensive regulation has come out from central bank, which is talking about how companies can plan for the worst case scenarios. And the emphasis here is on planning because as I will talk later in the presentation, that it has been mentioned that the stresses and the scenarios that you think of has to be such that the company is near failure. So the emphasis is very clear that companies need to think about scenarios which will really challenge the solvency of the company and the survival of the company, and how companies would recover from that phase. So the recovery phase, in terms of how the escalation will happen, who will take the actions, what recovery options do you have, what are the timeline, So everything has to be described here in a comprehensive manner, and eventually the end result is that companies needs to have a plan that, okay, you have your business plan and everything, which is growth focused, but this is the plan where if something bad happens with the company, then they don't have to panic. Like they have a plan that they can execute straight away. So this is a little bit of about the regulation that this is introduced on 25th December 2023, and the submission deadline is 30th June. And if you are working in UAE insurance sector, then I'm sure you must be aware of it. This week is the last week, so everybody is struggling to complete it, and because it's a new regulation, so there are a lot of things that depends on interpretation. So we will try that through this session we clear some of the doubts that you have, and some of the engagements with our clients that we are doing, so we can give you some samples of how the approach that you can take for each section. I also want to cover the global context. Like this is what you have seen in Dubai, but across the world, when you look at it, so you will find that similar recovery planning related regulations are there. The names are different, but the idea is that every financial institution should have a plan for the worst case. So in European Union, we see Bank Recovery and Resolution Directive. In the US, we see Dodd-Frank Act. In UK, we have PRA Rulebook for Solvency II, etc. And then Australia and Canada, so on, right? And even within the UAE, the recovery planning is introduced on banks and all other licensed financial institution. So it is very clear that if you are a branch of a foreign insurer, or if you are a local capitalized insurer, so everybody has been treated equally, and everyone needs to have a comprehensive report for recovery planning. Some of the requirements that are given in the regulation, that when you submit the plan, what needs to be part of that plan. So first section is obviously executive summary to summarize the whole report. Second is summary of material changes. Now this recovery plan is going to be a annual submission requirement. So for the first time, like now, this the report that you will submit now, so you don't have a record of what of the past. But from next year onwards, this section will also be important, because you have to disclose what material changes you are doing from last year. Then the background of institution, which can cover company SWOT analysis, companies strengths, companies budget numbers, or companies plan for future. So everything you can include in the background. And the next sections, governance framework, stress scenarios. These I will cover now one by one in the presentation. So governance for recovery planning. So governance in general, you guys may have seen that central bank has been emphasizing since last year. The corporate governance regulation was also introduced from the same idea that companies needs to have a thorough corporate governance plan in hand, and this is part of the same exercise that for recovery planning also companies needs to have a clear governance structure. What are the key points for governance structure? So, first thing is all the members of the senior management should be part of the process, because you have underwriting team, and you have reinsurance team, and business development team, and then you have the control functions like risk function, actuarial, etc. So the inputs from each member is important, and because this in the end has to be owned by the senior management. So the first part is very clear that everybody needs to provide their input. Second is chief risk officer or finance officer can lead the development of the plan. The role of CRO in the past was not spelled out so clearly, but from last year, when the corporate governance regulation came in and then the risk management regulation, so the CRO role has been defined and has been given the importance that it requires. And that's why for the recovery planning report, companies can think about giving this planning and development part to the CRO of the company. Then the internal audit, which is part of the control function, so that the internal audit role is important, that they needs to do an independent review of the plan. And finally, the board of directors needs to approve the plan itself before the submission happens to the CBUE. So some of the insights that we can give on governance aspect, that we need to broadly cover the roles and responsibilities of board of directors if the company is making a recovery management committee, etc. So you can make it part of the governance structure. Secondly, we also need to include a escalation matrix. So now what will happen, that companies are tracking the indicators, but how things will flow within the company. That once you start to see some problems, then who is going to report it, and what actions the company will be taking, who is going to be the owner for a specific task, and how things will go to the top. So if it's like a small deviation, it might be that the certain executive team members can take the action, but if the deviation is very high, like a big catastrophic event happens, then the escalation needs to be done by the by a very senior member like CRO or finance head, etc. So the escalation matrix is has become very important. Then some points on recovery indicators. So companies are used to using the KPIs for performance. So this is the same way that companies now need to track recovery indicators. So these are will be the initial signs, like showing how potential problems are happening. And then companies also needs to set out the threshold levels. So to give you an example, let's say you are tracking the solvency indicator MCR. So now the recovery indicator itself will become the MCR, but if it's just 1 or 2% deviation, companies might say that we are not reacting, because this is part of the day-to-day thing that organizations go through variations, and some level of uncertainty is accepted. So companies can say that within this level of uncertainty, this will be our acceptance boundary. But if the uncertainty is very high, like MCR changes by 20%, then who is going to take the action? But and if it's even more, then who is going to take the action? So within the recovery indicators, companies can put the thresholds, and that's how companies can take the actions accordingly. Some of the recovery indicators that we are using for our clients are for capital indicators, MCR, SCR, MGF. This is anyway companies normally track for solvency purposes. Then liquidity indicators like current ratio, profitability indicators, and asset quality indicators. And a good source of tracking of these indicators is e-forms. So now you would know that e-forms have a lot of ratios appearing. So companies can pick up ratios, the important ratios which are related to recovery planning, and they can track those ratios either monthly or a quarterly basis. The second is scenario testing, and the scenario testing is not new to insurance world. Companies are already doing it in the past. For FCR purposes, also companies have to do scenario and stress testing. But here, three categories of scenario testing are required, and this is new, that additional guidelines are being provided. So first is company specific scenarios companies need to make. Second is system wide scenarios, and third is a combination. And the emphasis is that the scenario should be such that it affects the companies to a near point of failure. And this is, the key point here, that because you can always make a scenario where some after even stresses, companies are in a good shape, and then the planning will not be so severe. But if you have a very severe scenario, then the planning needs to be done accordingly. Some examples of scenarios. So for company specific scenario, you can choose operational stresses, decrease in GWP, increase in claim ratio, increase in GNA expenses, etc. So everything that has to do with company level, you can decrease your new business. So whatever your plan is, you can do the scenario, and that will become part of company stresses. The system-wide stresses is bigger thing. Like something happens to the equity market or real estate market, and you suddenly have a drop in your assets. So this is the system-wide stresses, and the third is a combination of both. Then once you see that after the scenario your solvency position is not looking good, then what are the options that companies have? So companies can here some guidelines are also provided that companies can choose a wide range of options. So you don't have to give just one option because you are talking about planning. So you can give different options and what are the impact of different options. And every option that you are giving, we also have to show what are the timeline that it will require. For example, if you say that companies will invest, let's say, a certain amount as capital injection, then what are the timeline that the company is looking at? And then you have to show the impact of the capital injection within your plan. So this is the great part that, we are not just talking about the qualitative level of planning, but we also have to show that if a severe scenario happens, then how companies will recover, like what is the timeline. And here the input of management is very important because every member has to come up because the recovery option can be different thing. It can be the reinsurance optimization. So whatever option company is choosing, the senior management have to be agreeable that this is the realistic timeline that we are looking at, and then you have to include the impact of that within your planning. Some of the recovery options that companies can consider, again from our discussions with our clients, we can propose few options. So one is obviously if you have a scenario where profitability is challenged and the company was looking at a very high growth, and then the loss ratios were also increasing, then you can think of a scenario where underwriting will be more stringent and loss ratios will improve. Secondly, the admissibility of assets. So if the company has inadmissible assets, so you can give a plan that how long it will take to make those assets admissible. Third is capital injection. Companies can again give a plan that whether the existing shareholders or the new shareholder or whatever the process is, then how likely is that companies will be able to arrange the capital and what sort of timeline companies are looking at. Then reducing expenses. This is part of the controlled exercise that company exercise control on the expenses. And again, you need to discuss with different departments if we have to do cost control exercise and how long this exercise will take. And finally is the reinsurance restructuring because the sometimes the reinsurance is not optimized. So you can do a reinsurance optimization, and that exercise might lead to some benefits in solvency. Then communication plan. So again, as I mentioned that here the regulation is emphasizing on what steps companies are taking, and the regulation is very comprehensive. So that's why the communication plan requirement is also added that once you are hit in terms of recovery, then what actions are you planning to take in terms of communication? So it's internal communication with your employees, then external communication. If it's a listed company, external communication will become very important. Communication with regulator because they will look for a plan, communication with stakeholders, and media communication. So you have to include all of this communication planning within your report. And finally, the conclusion, I would say that it is a very important steps in terms of companies planning exercise because what we are seeing that uh, it's not just that company specific events can happen. The external events which are not under the control of companies may happen, and those events may challenge the survival of the companies, like the April floods that has happened. So we have yet to see the losses and the impacts on companies, but that is just one of the events. So many the possibility of unforeseen events are limitless, and that's why the planning for such events and the action items are very important. And financial, I mean, in the end, the objective of central bank is that when every financial institution are ready with a plan, then it will help in the stability of the overall financial institution. Uh, that was it from my side. I hope you found it insightful, and Please share your questions on the chat. We will take the questions at the end of the session. Thank you.
Thank you so much, Mr. Hussain, for sharing detailed information on recovery planning. I'm sure we have more questions to ask on this topic. We'll be getting many messages. We're already getting many messages, and we'll reply to you by the end of the webinar. Now, we would like to welcome Mr. Login, the CEO and founder of Bayes Actuarial Services, to share his part of knowledge on the hot cake of today's market, insurtech industry.
Thank you, Rahim. Thank you, and thank you, Hussein, for kindly inviting me and allowing me to present my little knowledge in this area. So, InsurTech, before I showcase my presentation, just want to say a few words. Base Actuarial Solutions is actually based out of Malaysia, and we are part of DD Consulting. We provide services in Southeast Asia and beyond as well. And I lead the InsurTech division of the DD Consulting Group as well. So why is InsurTech becoming such a hot topic right now? There's a couple of perspectives to look at. One is our regulated industries, insurance and the banking industry is traditionally very risk averse, with good reason, very highly regulated. So the InsurTech industry comes to as a way to innovate, both to help the existing incumbents innovate and meet the demands of customers. And secondly, to come in with new models. Previously, many years back, they used to use the word disruption. In some cases, we have seen disruption in the fintech industry, but right now the theme is more around collaboration. There are some strengths that fintech players, insurtech players can bring in, but we have some core strengths in the traditional insurance area as well, which needs to be combined for effective innovation. Now, without further ado, I'll share my screen. All right, so navigating the future of insurtech. Now, what is insurtech? Insurtech is actually very varied. There is a lot going on, and it's tough. It's difficult to say that we know everything in the insurtech world. It's a constantly evolving space. Within the insurtech space, there are a lot of different types of insurtechs. There is insurance as a service, similar to software as a service, but where insurance products are built outside an insurance company and through partnerships or through other models. Insurance is delivered in different ways. We have MGAs, managing general agencies, coming out of different locations, offshore locations maybe. And then we have digital insurers. This may come through digital insurer licenses or incumbent insurers who operate on a highly digitalized model. Software as a service, SaaS has been around for many, many years. We have digital platforms and aggregators who often partner with insurers. Peer-to-peer insurers is, although it's a very fancy term, the very origin of insurance was through mutual aid, where people came together to help each other. So it's a throwback to the old times, but enabled by technology. And then we have usage-based insurance, where you only pay for what you use, or on-demand insurance, on the other hand, where you buy insurance when you need it. So sort of like the Netflix of the insurance world. And then we have the Web3 world. The Web3 world is a whole big domain by itself, and it's highly uninsured. We have, of course, the cybersecurity issues in Web3, where cyber insurance can really help. And Web3 itself comes with a sort of a framework or sort of a DNA that helps democratize insurance, and it can actually provide different ways of delivering insurance from the traditional model. And then, of course, there are lots of others as well. Now, when we see what domains they serve, so those were the insurtech sort of vehicles. If you see which domains they serve, so it's sort of the traditional insurance domains and beyond. But traditional insurance products typically don't work in the insurtech domain. There is a reason why the insurtech domain exists, and it's more often for the e-commerce industry, for the digitalized style of living, to penetrate into underserved, underinsured segments, and try to deliver offerings which are different from the norm. So health is a very big domain in the insurtech industry, which is powered by the Internet of Things, wearables, and it helps people improve their lifestyle in addition to just providing health insurance by itself. And health and life insurance go hand in hand, but the type of products you see in the insurtech domain for life and health are often very different from your traditional insurance products. So you don't see your traditional agency, endowment, investment link type of products in this space. It's more sort of fit for purpose, sometimes embedded insurance, sometimes bite-sized insurance, and very differently built products. And then, of course, the travel and e-commerce platforms are big, and these industries, actually travel has recovered very well post-COVID. So that is a big space with endless potential. E-commerce now it's become the norm for us to shop online on various platforms. So that provides an opportunity for various types of insurance or insurtech players to partner as well. The fintech industry has become a standard now. I don't know whether you remember the times where we used to have to hail a taxi and not know what we'll be charged. So, but now those days are gone. We have Uber, we have Grab in Southeast Asia, and we have a lot more of these sort of disruptive e-hailing players, and that comes with its own set of needs. Gig working has become the norm as well with the fintech industry, and gig workers typically are underinsured. So this fintech sort of insurtech offerings suited for gig workers continues to be a need, largely unfulfilled need as of now. Cyber insurance is set to grow as well. Crypto, that's the huge space, somewhat related to Web3 as well. And when we speak about crypto, it's not only about cryptocurrencies and your bitcoins and etc. It's also about the blockchain technology that holds quite a lot of promise. I would say it's still largely untapped, but there are some pockets where the blockchain technology has been adopted successfully. Telematics is often used in the auto insurance space, and that has worked quite successfully to bring down prices, to make products more affordable and relevant for customers. And then wearables in the context of health insurance. We have home insurance, insurtech offerings as well, and of course, insurtech offerings for vehicles and other spaces. So the key takeaway here is insurtech domains are not that different from insurance domains, but what the relevance and the fit for purpose sort of build that the insurtech domain, insurtech products bring is what sets them apart. Now, those were all the exciting stuff about insurtechs. But at the end of the day, insurtechs also play in the insurance space, and we cannot ignore the critical functions that they need to have. Legal and regulatory compliance are of paramount importance for insurtechs because insurtechs try to innovate the insurance space, rebuild products in different ways, rethink service offerings, and all of that. We need to recognize that the insurance industry is a very highly regulated space, and the cost of not being compliant to legal requirements or regulatory requirements is extremely high. It can just bankrupt a company. It can put you out of business. So starting with a proper legal background, legal framework, understanding the laws of the domain you're entering, and understanding the very complex regulations is extremely important. And you need to spend the homework, and you need to get the experts that sort of expertise we can provide as well. Now, strategy, product design, pricing, I would actually tie it all to this word risk management in the middle as well. So risk management is something that needs to be interwoven into every aspect of the InsurTech's build. Quite similar to how ERM works in the traditional insurance space, is pretty much the same, but more fit for purpose, I suppose. So when the InsurTech is being built, it's being strategized, all of that, the risk management needs to be taken care of. Otherwise, the cost of not being risk, what do you call it, protected is extremely high. It's, will make you insolvent. So in terms that, so that comes in the way you build products, what type of products you offer, the types of market, the marketplaces you enter, the pricing strategies you employ. All of these need to be thought of very carefully. And the need for innovation is extremely important. So of course, traditional approaches that we take in the insurance industry, not just fit for purpose as it is, but we need to often innovate it, modify it with judgment and expertise. So that part is very important. Capital modeling is also a very important thing. Bear in mind, we are in the business of taking risk. So when we take risk, we need to understand it and we need to set aside proper capital amounts. So often the InsurTech founders and innovators come from different spaces and from non-insurance backgrounds with good reason, because they come taking in a different perspective. But often what they miss out is insurance risk or insurance-like risk is intangible, and you need to model the capital differently. You need to understand how much capital it actually takes. It's quite different from the traditional, capital that you just set up for other businesses, which is just related to your tangible expenses, operating expenses, etc. So yeah, that needs to be mapped out and understood quite well. And the capital modeling can often go back and it's like an iterative process. Then you would rethink your strategy, your product design, and then look again at your you identify your risks involved, and then identify what type of whether you take a partnership model or go into different areas. And then for InsurTechs, now partnering, so the partnership approach works quite well for InsurTech these days. With, of course, not all the time, but in most cases, it does work quite well. So liaising with insurers and reinsurers is really important, and often it's important to speak the same language. Of course, insurers and reinsurers get excited by the innovative, different language that InsurTech founders bring. But when it comes to the, doing the meat on the bones, the real stuff, then you do need to speak the language, a similar language. Otherwise, it becomes very difficult to keep up a partnership, because insurers and reinsurers need to have profitable or at least sustainable businesses as well. And then the regulatory sandbox is a very interesting space. It is becoming bigger and bigger. I'll go into that in the next slide. So liaising with the regulators in the regulatory sandbox is also an effort on its own, because these are regulators who come from the traditional space, and they may not be well. They try to be innovative. I have to give them the credit. They are often very proactive, innovative, and all of that. But you do need to speak a similar language. You do need to understand where they come from. You do need to meet their needs to ensure that the guardrails are in place and all of that, which I will go into after this. So the regulatory sandbox is an interesting space, and it's been going on for quite some time. So here I've listed down examples in Malaysia, Singapore, the UAE, but it's also available more broadly than that. It's in the UK. Qatar has its own sandbox as well now, and Saudi also has its own sandbox, if I'm not mistaken. And so the openness of regulators to InsurTech innovation is actually increasing. Bank Negara, recently we had our sandbox open day just earlier this week. The UAE, the central bank, actually just officially launched the sandbox, regulatory sandbox, just this week as well. I don't know whether they timed it together. So the recognition of regulators about the importance of this space is growing. Now, what is important when you enter into the regulatory sandbox is understanding where the regulator comes from. Of course, the regulator wants you to succeed. So they will look at your business plans, how you're going to scale up, and all of that, whether you're meeting a need in a different way. So all of that is important. But risk management is a critical element. Because we need to understand that the regulators are in charge of the integrity of the financial sector in each country. So they need to make sure that the players are acting in a way that will not harm the customer's welfare. So in the insurtech context, startups are prone to failing, right? Startups by nature, they are innovating, they're doing something new, and they are starting up from fresh. So the risk of failure is high. So now so this is fine in other industries, but in the insurance industry, when insurance provider fails, this actually harms the customer quite a lot because it's insurance is an intangible good. So if an insurer fails, the concept of risk transfer or risk management, all of that sort of falls away. The faith of the customer in financial institutions can be also affected. So that's a lot at stake for regulators. We need to understand that. So having a risk management mindset in place is really important. So when I mean risk management, I'm talking about legal risk management, compliance, cyber risk, actuarial risk management, from a product design approach, strategy approach, communication approach. So that needs to be interwoven in all of that, and to make sure that the customers there's a plan to take care of the customers, there's a way to take care of the customers even if the business doesn't perform well. So all of that needs to be taken care of, and that's a common theme we see across all regulators across different regions. And you can see the regulatory sandbox has been around for quite some time. Even in UAE, there's another regulatory sandbox with the DFSA. Now the CBUAE has launched its own sandbox as well. And so this is all in the interest of innovation and creation. So and now, before I end my my presentation in the true nature of actuaries, I want to scare you a little bit with why risk management is important in the insurtech space. So these are some examples. This is not exhaustive at all. This is just a few examples of insurtechs that failed in the past due to a lack of risk management strategies. So these come from across the world, and if you think if you raise enough money, you'll be immune to this, it's not true. This last company on the right here, VFox, a German insurtech, actually raised up to 4 billion US dollars. It's a crazy amount of money, which is larger than the capitalization of many, many insurance companies around the world, companies that have lasted for hundreds of 100 years. So despite having that big capital base, they are under distress now, and there are talks to sell off the business for like 20 million euros and stuff like that. And the key reason VFox is struggling is because of oversight on regulatory and financial requirements. So they didn't have the adequate capacity to manage the regulatory landscape and have risk management abilities, and that's like a backbone. So when you don't have your backbone in place, even if you're able to commercially scale up, even if you're able to really rapidly expand, if your key, for an insurtech, just like an insurer, risk management from all aspects is your backbone of your business. So you've got to take care of that before you get very ambitious as well. So that's a message I wish to just convey before ending. Yep. Thank you, Rahim. Back over to you.
Thank you, Mr. Logan. That was an information. Yeah, that is an important breaking news which you shared for the UE content, and which has been launched by CBI UE in this week. Thank you so much for updating on that. Our last presenter, Mr. Hasnan Azhar from DD Consulting, working as a senior manager, is going to present the importance and detailed information on understanding risk management frameworks.
Thank you, Raheem, and thank you everyone for joining today's session. Um, Today's I'm presenting, importance of risk management and also the key regulatory aspect in the UAE market. Uh, as my speaker Hussein and Logan have already highlighted some aspects of risk management regulations and risk management importance. So I would be going through in this presentation mainly the requirement listed by the central bank of UAE. So we all know that in 2023, central bank has issued the detailed standard and regulation for risk management and internal control functions for insurance companies. These regulations are applied on listed insurance companies as well as foreign branches, operating in UAE. Previously, there were always misconception that these regulations are applied on foreign branches or not, but now it's very much clear. So any company that is not compliant with this regulation, on this that effective date, the central bank asked detailed plan to comply within 90 days, by 90 days of the issuing of the risk management framework. So the risk management regulations are there since 2015 in UAE financial regulations, but in the central bank has issued the latest version of risk management regulation, uh, and what they've asked from the insurance companies to prepare a robust regulatory framework, to promote the strong risk management practice across all insurance sector, whether it's a branch or whether it's whether it's a foreign branch or whether it's a listed company. At the core of this framework, there are some specific requirement and guideline for the insurer to complete comprehensive, enterprise-wide risk management program. These regulations actually, as I mentioned earlier, is compulsory for every insurance companies in the market to prepare first risk governance structure, identification, assessment, mitigation plan, and these committees should have formed in order to cope up with the potential risk. Central bank is the aim of the central bank is to empower the insurance industry to build long-term sustainability by introducing these risk management regulations, and to better protect the policyholder, because insurance is a business of risk, and risk management is very necessary and crucial for any insurance company uh, to manage. And but properly implementing all these risk management regulation, uh, we believe that insurance sector of the market will overcome the challenges, just like we are facing the challenge of flood risk at the moment in UAE. Cyber risk is another example. It's a growing risk. So by adopting all these regulations, the market can benefit from potential risk in futures. So there are mainly three aspects of risk management framework in the regulation. One is the solvency reporting, which was already there in the financial regulation, that each company have to submit quarterly solvency report, and they have to provide justification of their capital breach if they are breaching the solvency requirements set by the central bank. The solvency reporting, helps regulator to monitor the financial health of the insurance company and identify the potential risk, as explained, by Mr. Hussain in earlier presentation. That we do have now recovery plan reporting as well in place, which is also a greater part of ERM frameworks. In the long run. So ERM plan outlined the insurance process for identifying, assessing, mitigation, and various risks, ensuring the robust and adaptable risk management strategy for any insurance company. The governance, control, and the governor's control is actually the major part of the newly introduced framework, which was in 2023. So they have the central bank have circulated the detailed corporate governance structure requirement for each insurance company in the market. So they've asked companies to make different committees, risk committees, audit committees, and additional board of directors as well in the corporate governance. So monitoring the risk management is responsibility. So the central bank have added board in a monitoring position of risk management framework uh, for any company. So why I mean risk management is important for this regulatory requirement is very important in the market. Number one point,
We have some disruption. Ray, maybe you can take some questions on the chat because Hasnain.
Yes, I
Uh,
think so. There's some network issue. So we will just take up some questions which we got earlier. Somebody had said that, hi, can you please share? Okay, so in the summary of material changes, do we need to mention any changes? Example, bonus share issued that has happened during the January to June 2024?
So I'll this is about recovery planning, so let me take it. So thank you, Sunil, for asking this question and being part of this webinar. So the material changes section is actually talking about changes from previously submitted plan. Because this is the first time companies are submitting this plan, so that's why I would think, in my opinion, this year we don't need to mention. But from next year onwards, whether there is any material change in the institution, like you mentioned, bonus shares issued, or whether there are changes within the plan itself in terms of recovery options or in terms of stress scenarios. So those needs to be highlighted in the material changes section. I hope this is clear.
Okay, another question by Hanan is, hi, we are a foreign branch and the parent company fully supports the branch. Can you please show the options?
Thank you, Hanan, for asking and again for attending the webinar. So yeah, the applicability on branches, as you may have seen that from last year, ever since the corporate governance regulation came in, and then we have the risk management. So the regulator is having an equal treatment across the board. So whether it's a local licensed company or whether it's a foreign branch of, whether it's a branch of a foreign insurance company, so the applicability will be the in the similar manner. Now branches needs to do the same level of planning, that they needs to do the base plan projections first, and they need to apply the stress scenarios, and the branches needs to show that they are independent in terms of decision making. So even if you have a support from parent company in terms of financial resources, human resources, the branches needs to show that on the branch level they are ready if any stress situation happens. So to give you one example, that if you have a stress scenario and you are showing that we you will need to arrange a certain amount of capital from the parent company, so that support you can always mention, but you need to show that how long this will take, and what will be the impact after the capital injection. So it has to be done in the same manner of planning like any other company is doing, and you need to now show that what level of support parent company is ready to provide, and what will be the timeline for that support.
I think so. The next question was by Azim, but it was already answered regarding InsurTech. How are traditional insurance agents adapting to the rise of insurtech platforms? And what does the future holds for distribution channel in insurance? I,
I I think this one is for Logan,
Yeah,
and
again,
yeah,
it's
Robin has
already,
responded in chat. Yeah.
yeah.
already responded.
How is the recovery plan different from the ORSA report submitted earlier for insurance companies?
I would say on a principal level, the ORSA, the how the name says that its own risk solvency assessment. So ORSA focus was on developing internal capital models. So companies should evaluate their solvency in their own context. They should have their own internal capital model. They should have their own way of underwriting, calculating underwriting risk, investment risk, etc. So ORSA was kind of a parallel solvency framework, and the emphasis on ORSA was on companies to use a different calculation model for solvency, number one, and some stresses to also include and to show the impact that how their solvency is different to the regulatory solvency. But when you look at the recovery planning, here the emphasis on the solvency, the way it is currently being submitted and calculated in the E form. So the focus is shifted again to the solvency, the regulatory way of calculating solvency. So you have to use the same E form approach in the recovery planning, and here the focus is on extreme scenarios. So where ORSA companies might say that 10% of expense risk is a stress for us, and then you show the result. In the recovery plan, you have to show a large amount of stress so that you can show that your solvency is really hit and what is now your action plan for it. Okay, so in that context, both reports are significantly different.
Okay. Another question was, my question is on recovery planning. Like, what are the legal factors need to be considering in recovery planning?
So I think legal and compliance, I think it's important. And obviously, first compliance requirement is the deadline of timeline. So 30th June is the deadline. Second, I would say the development of the framework, recovery indicators. So uh, all the requirements which are there in the plan, so that is essential to follow. Companies can always include additional information, but the minimum requirements are already part of it. And this is one difference to the ORSA regulation, because ORSA has a very high level broader guidelines from the regulator, but recovery planning has very comprehensive guidelines. So each and every section or the requirement has been explained. Even the stresses are already explained, that you need to have three categories of stresses and you need to stress on the near point of failure. So those all those information are already there. So I would say that in terms of legal requirements, the regulation introduced for recovery planning, though that compliance with that is very important. And even within the report, something that we are doing for our clients, that it is a good practice that you also include how you are complying for each clause of the regulation. So you need to give a reference that what part of the report is complied to what section of the regulation. So that mapping will help you making sure that you're not missing out any of the requirement of this regulation.
Thank you so much. We will continue with the questions. We'll just complete the. We'll be back to Hasnan.
Thank you, Raim, and really apology to all of you. There's some technical glitch. I'm sharing my presentation again, and we'll resume from there. Right. So we were discussing robust risk management for UAE insurance. companies, which is required, which is required in central bank regulations. So, very firstly, top management and governance oversight. So, central bank specifically ask insurance companies to uh, appoint CROs, manage risk committees, and also, approval from the board of directors of the company for each risk management policies, which is required by which is required by the uh, central bank in the regulations, whether it's branch or whether it's uh, the listed companies. They are required to oblige all of the regulatory requirements. So in case of branch, where there's no board of directors, so the branch managers are responsible, for the approval of ERM policy. Um, Requirement for the dedicated risk management committees reporting to the board, and designated CROs so that they can present risk management policies to the board or senior management of the company. Uh, Earlier this year, we do have implementation of own risk solvency assessment process as well, which took place, and all the companies have already submitted solvency assessment report, own risk solvency assessment report based on year end 2023. Also, there's a detailed guideline about managing the emerging risk, managing the new risk or risk registers. Secondly, uh, aligning your risk or your own risk or strategy, aligning the organization risk appetite and tolerance level with the strategic objective, and stressing the business plan through various adverse scenarios, so that the companies may prepare them for the worst case or adverse case which hit them in future. Currently, we're facing challenges for the flood risk. Cyber risk is another example of a newly emerged risk. So that's the reason, in regulation, there is a dedicated risk committee requirement, a board level risk committee requirement, which review and affirm the risk management policy of the company. So moving forward, we've already discussed why it's important, the risk management for the insurance companies in the market as well as worldwide. But I'll just briefly explain in three agenda point. One is, which is very important, regulatory compliance. So insurance companies in UAE and other market as well must comply to the regulation set by the regulator. Compliance with these regulations is very crucial in maintaining their licenses, because nowadays there's a lot of challenge from the regulator to insurance companies in the market that, in order to comply all these regulations, uh, which eventually help the companies to maintain and obtain the financial stability which they are targeting in their business planning or in their underwriting targets. So effective risk management practices help insurance companies maintain sufficient capital and liquidity level. This also help and ensure that they can meet their obligation to the policyholder, which is very important. Even during the time of market, volatility or financial stress, which we have seen, in the recent time, uh, you know, by adopting good risk management practices, companies can offer, a very stable return to the shareholders as well, and obviously the policyholders as well. Uh, the the last list in my importance of risk management in insurance companies is, competitive advantage. Implementing robust risk management practices can significantly enhance an insurance company reputation in the market, and a strong reputation build customer trust, making it easier to attract and retain client base. Additionally, I would say effective risk management allow insurance to offer more competitive and well-priced product, given, because insurance companies are managing that risk effectively, then they'll price that risk effectively as well. Moving forward, in this slide, I would like to present, comprehensive risk management framework. how it's compromised. Like a risk management framework is I would say, holistic approach to managing risk in insurance company. It involves proactively identification of potential risks, assessing the likelihood and impact, and developing strategies and mitigation plan. For instance, recovery planning is part of a overall risk management framework, which is developing strategies and mitigation plan and future. ORSA is also requirement by the central bank, which develop the strategy. By the other good thing about comprehensive risk management for any insurance company, the structures allow um, the insurance company long-term stability and sustainability by addressing wide range of challenges, whether those are new challenges in the market, or whether those are existing challenges. Um, uh, Previously, we remember earlier in 2021 and 2022, the market is, assessing, the market is adopting IFRS 17. That is also another risk or another challenge for the market. So when they are adopting different systems, so they have to assess the risk of that tool or software which they are adopting in future, because cyber risk is going to associate with third-party vendor softwares. So this is another challenge which market have to cope up now. Uh, Comprehensive risk management framework. It's organization-wide approach to risk management, going beyond just focusing on specific risk. So it's not just your underwriting risk or your financial risk or your credit risk. It's your reputational risk as well. It's your market risk as well, and it's your regional risk, political risk as well. So in the comprehensive risk management framework, companies have to um, plan and uh, design the risk registers in a way that all the potential risk associated with them and associated with the market should be addressed and should be there to review the senior management. Uh, Finally, the best practice of risk management for UE insurers, or we could say that we can say that for the market as well. I would highlight these 4 points. Uh, the best practice for any insurer is like to uncover potential risk, their risk, their own risk, the market risk as well as the global risk. For instance, there are war risks involved everywhere in the world. So there's one war which happened in across 7 seas in Russia and Ukraine, and everybody in the world has disturbed even the whole financial market. So the UE industry faces wide range of risk, which require proactive management to ensure long-term success. The recent flood is very good example. um, Cyber risk is another growing risk. Data privacy, IT security is another growing risk, which companies should need to target in their risk research, and taking proactive measure against those risks is very beneficial in long run. Uh, so, but when you identify the risk, then you have to prioritize the management effect while using different analytical approach, whether it's quantitative or qualitative. So when we discuss quantitative, it's recovery planning is a very good example of quantitative risk. And if we discuss qualitatively assessment, then I would say succession planning is another good example of qualitative risk. Nowadays, is a big challenge in the market to find out potential resource, a good resource. So succession planning is a very crucial, in the form of qualitative risk. So developing the tailored strategies, this address mainly, I know it is very important to prioritize risk management effective by evaluating the likelihood, impact, and exposure of different risks by adopting uh, different stresses and scenarios. Tailored strategies should be developed according to the company uh, portfolio size, and expansion plan. uh, the regular review and updating of risk profile is very crucial, because market is keep changing, your risk is keep changing. So there is this is very essential that companies management, senior management, and risk owners review the existing and potential risk uh, very regularly. Finally, uh, I would say this is all about the importance of risk management and current CBU regulation about ERM framework and internal control function. I would thank you everyone for your time. I hope we have covered as much as we can in this short time period. But if you have any questions, you can reach me out, and we will share this presentation as well. And if you have any question now, we can answer those. Thank you, everyone. Over to you, Rahim.
Thank you so much. Thank you so much, Mr. Hassan Azhar, for your insight and information. And yes, you all can ask questions. There is some question. What is
Yeah,
the likely impact of floods for companies?
yeah. So this is really the UAE market. So I will take up this. Basically, floods in the UAE can cause property damages, interrupt business activities, and lead to more insurance claims paid. The companies, specifically those without enough flood insurance or backup plan, in terms of that's why the UAE insurance regulatory they are imposing the different regulation in terms of solvency recovery plan. So might face financial difficulties. So the insurance market financial health could be stressed due to more claims payment and a lower premium income. So strong regulation, adequate capital reserves, and insurance strategies in the UAE insurance sector are expected to help maintain market stability despite these short-term challenges. Like if you will talk about from the e-form perspective, like liability will increase significantly, particularly in terms of outstanding in IBNR, impacting the basic own funds. The solvency will impact in terms of SCR, MCR, and MGF. So insurance companies that haven't set aside sufficient reserves so to cover flood losses during quarter one, they will struggle more and suffer greater financial losses.
Thank you so much. Thank you so much. There's another question. How do you see solvency position of overall market?
Basically, this I have covered in both the question in one response.
Okay.
Yeah.
So, guys, if you want to ask any more questions regarding the topic which we had today, if you have any questions, we are sharing our email address. You can always drop in your email. You can send an email over there, and we will be sending you the presentation by email. Just send your email to support@digitaldata.com, and we'll reply back to you on that. Thank you for giving in your time. Thank you for joining in for today's webinar. Have a nice day.
Thank you, everyone. And I think we will also be sharing the recorded